Hello, everyone.
Hello, sir. Very good afternoon.
Hello,
How are you, ma'am?
I can't hear you.
Hi, good afternoon, everyone.
Good afternoon, sir.
Good
Dr.
afternoon,
Raji, how are you?
everyone.
Good afternoon. Hi.
Good afternoon. All these speakers are here. We can begin.
Hi, Ankita.
Hi, Anjali. Hi, Sarthak. Hi, Prakash.
Hi,
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 Soumya.
hi.
hi,
Hi,
Ankita.
ma'am.
Hi,
Hi,
Soumya.
Pranshu.
Hi, Pranshu. Hi, Anjali.
Hi, how are you?
Good. Thank you.
All right then. Hello everyone. A very good afternoon to one and all present here. It is absolutely an honor to welcome you all to BRICS CCI's Insight on Budget 2026. Today, as we all know, we have gathered here to decode, deliberate, and discuss the impact of Union Budget 2026 on businesses, industries, and larger economic landscape in India. As we all are aware, Honorable Finance Minister Srimati Nirmala Sitharamanji has unveiled the roadmap of next financial year, aimed at strengthening India's economy, fostering self-reliance, and driving growth across multiple sectors. But what does this budget truly hold for businesses, industries, and most importantly, the common man? Every year, the union budget brings expectations, hopes, and policy shifts that shape the economic landscape of our nation. It definitely impacts industries, entrepreneurs, and startups, and large corporations, and even everyday consumer like me and you. From tax reforms to GST revisions, from new incentives for businesses to relief measures for middle class, let us discuss all today and how these impact to one and all and every aspect of industries. As a platform for policy insights, BRICS CCI is committed to fostering informed dialogue and strategic engagements. This discussion will not just focus today on numbers and allocations, but will directly dive deeper into the practical effects of the budget on different economic players, including MSMEs, investors, and individual taxpayers. Joining us today, we have a panel of esteemed professionals having years of expertise in the industry. Join us to welcome CA Sarthak Garg, partner Garg Manoj and Associates, and convener BRICS CCI Indirect Tax Vertical. Advocate Ms. Soumya Panda, founding partner Panda and Associates. CA Pranshu Goyal, partner Ashok Pranshu and co-convener BRICS CCI Direct Tax Vertical. Advocate CA Prakash Sinha, partner Finjuries LLP, and CA Anjali Gupta, partner Song & Co. To formally commence our proceedings, I would like to invite CA Sarthak Garg, who is also the co-convener of Indirect Tax Vertical at BRICS CCI, to deliver the opening remarks and set for the stage for today.
A very good afternoon to all the members, esteemed speakers, and participants. Thank you, BRICS CCI, for organizing today's webinar on the insights of the budget. And thank you, Lavanya, for the introduction earlier. And it's my privilege to give the opening remarks for today's session on the Union Budget 2026-2027, which was presented by the Honorable Finance Minister on 1st February. So this year budget builds on India's growth momentum and aims to propel the nation towards a developed India by 2047, with an emphasis on infrastructure, manufacturing, competitiveness, inclusive development, and ease of living for every citizen. So the public capital expenditure has been substantially raised, reinforcing the government's commitment to asset creation and economic growth. Major transport and connectivity initiatives have also been proposed in the budget, which includes the push for high-speed rail corridors that will significantly, improve travel times and economic linkages. This budget also strengthens the manufacturing and strategic industries, the expanded India semiconductor mission, together with the enhanced support for electronic components manufacturing and dedicated rare earth minerals, seeks to reduce import dependence, foster technological autonomy, and create high value jobs. So new schemes for the SME growth like the SME growth fund are designed to help micro, small and medium enterprises scale up and integrate with the global value chains. So on the tax and regulatory front, the budget introduces reforms which aims at simplicity and trust-based compliances. So key measure includes the implementation of the new Income Tax Act, which will come into effect from April 1st, 2026. The rationalization of the TDS rates, reduction in customs duty for imports, and exemptions for critical healthcare imports. So these measures are designed to ease the compliance burden on taxpayers and make India a more attractive investment and a business destination. So for ordinary citizens, the budget brings several people-centric reforms like staggered timelines for the income tax returns, making the filing process more convenient. Relief in tax treatment of motor accident compensation and liberalized remittance norms for education and medical expenses abroad. Agricultural and rural development are also crucial pillars of this budget. The focus has shifted towards empowering farmers through better price risk management, data-driven advisory platforms, and unexpanded insurance frameworks. So crucially, this budget strikes a balance between the growth and stability. While the government has planned a managed and record borrowing program to finance its development agenda, macroeconomic stability and market confidence remains the priority for the government. So in conclusion, the Union Budget 2026-27 is not just a fiscal document, but a blueprint for transformation, one that aims to boost economic productivity, enhance citizen well-being, and build a resilient and globally competitive India. So this was a brief overview of the Union Budget 2026-27. And should I start with the GST amendments first?
Sure, sir, please.
Okay, right. So I will now be discussing the GST amendments that has been proposed in the Finance Bill 2026. So at the outset, it is important to note that there are the number of GST amendments in this budget is relatively limited. There are only 5 amendments that has been proposed if you see the Finance Bill. So this is the primary reason because of this, limited amendments is that most of the changes have been made through the GST Council meetings that regularly takes place during the year. So in the 56th Council meeting, there were some recommendations that were made, the substantive recommendations, the changes that were proposed in the GST law. And the Finance Bill now seeks to give the legislative effect to these recommendations. So I feel that the encouraging factor behind the GST amendments is that the government has focused on ease of doing business, reduction of litigation that has been happening since the introduction of GST, and promotion of exports. So the 5 amendments are largely built on these 3 pillars, which I said: the ease of doing business, reduction of litigation, and promotion of exports. So from this perspective, I strongly believe that the government deserves full credit, as the GST amendments introduced are by and large tax friendly in nature. In fact, all the amendments are in the favor of taxpayers, and there is nothing, no amendment has been retrospectively proposed against the SSC or in the favor of the department. I believe that a conscious effort has been made to remove ambiguities in areas which in the past have been major contributors to disputes and litigation in the GST regime. So the most important and significant amendment in the GST Act that has been proposed in the Union Budget is regarding the intermediary services. So I believe that most of us here are familiar with the long-standing controversy surrounding the intermediary services. So the concept of intermediary is not new. It was first introduced in the service tax regime in October 2014, almost 12 years back, and has remained one of the most litigated and gray areas ever since in the service tax regime as well as GST regime. So thereafter, the same provision was carried forward in the GST regime and the litigation continued unabated. So over the years, BPOs, KPOs, marketing service providers, payroll processing entities, and accounting service providers, particularly those who are rendering services to foreign clients, have consistently remained under departmental scrutiny. So, technically speaking, Section 13 of the IGST Act deals with the place of supplier services where either the supplier or the recipient is located outside India. So, under the existing framework, in the current scenario, Section 13, 8, subclause B provides that the place of supplier services of intermediary services shall be the location of supplier of service. So, in the case of intermediary services, it's a deeming fiction that the place of supply shall be location of the supplier of services. Now, one of the most important conditions for a service to qualify as an export of service is that the place of supply must be outside India. So that is one of the crucial conditions that an exporter has to determine while assessing their GST liability, that their place of supply of services must be outside India, in fact. However, as I told you, the place of supply in case of intermediary services is the place of service provider. So, in case of Indian service providers who are supplying services to foreign clients, which qualify as intermediary services, it is artificially fixed in India. The location is artificially fixed in India, in fact, merely because the supplier is located in India. Accordingly, such Indian service providers have been denied the export benefits merely because their nature of services fall within the definition of intermediary, and despite the fact that payment is received in foreign exchange, foreign currency, and the service otherwise satisfied all the conditions of export. So this has, this deeming fiction has been clearly contrary to the very foundation of GST, which works on the principle of destination-based consumption tax. And as a result, genuine exporters of services have been denied export benefits. 18% GST has been demanded on such foreign income that the Indian service providers receive from the foreign clients. Refund of ITC has not been allowed. So, firstly, you are liable to pay 18% GST, and secondly, you are not able to claim the refund of ITC. And therefore, the whole industry, the service industry, specifically the BPOs, KPOs, marketing services providers, have been, pushed into endless and avoidable litigation. So, since the introduction of GST, we have also seen the constitutionally, challenges on the intermediary provisions, conflicting advanced rulings, high court judgments, going both ways in favor of the department, in favor of the assessee, and there has been a complete uncertainty on this topic. So now, after so many years, the government has acknowledged this ambiguity, and the Finance Bill 2026 proposes a complete omission of Clause B of Section 13, subsection 8, the very clause governing the place of supply of intermediary services. So, once the provision is omitted, the intermediary services will be governed by the general place of supply rules under Section 13, subsection 2, and the place of supply of services will be the location of the recipient. And going forward, the such intermediary services provided by the Indian service provider to the foreign clients will finally qualify as export of services, subject to fulfillment of other conditions. So I believe that this proposed amendment is very impactful. It would substantially reduce long pending litigation and further promote exports. It would definitely bring India's GST framework in alignment with the global VAT and GST principles. So the only question remains that what will happen to the past litigation, because this provision is being omitted without any repeal and saving clause. So the question is whether the intermediary services or the ongoing litigation for the past period will be will be reduced, or what will be its fate. So let's hope there is a clarity issued on this aspect as well. Further, for inbound services, intermediary services received by an Indian recipient from an overseas supplier shall be taxable now. So till date, when the amendment with respect to the previous, in the current framework, there was no RCM payable if you are importing intermediary services from outside India. But now going forward on inbound services, intermediary services which are received by Indian recipients from the overseas suppliers shall be taxable in India under RCM. So any taxpayer who is paying commission for marketing services rendered outside India to a commission agent, who is located outside India, shall be liable to pay 18% GST under RCM. But this will definitely increase the compliance obligations for the Indian service providers. But the impact would be largely revenue neutral, because the GST paid under RCM would be available as ITC, and the taxpayer would be able to set off against the output tax liability. So, going forward, once this amendment come into picture, the exporters, the Indian service providers providing services to outside India, shall get the benefit of export subject to the fulfillment of conditions. And apart from that, the Indian service recipients who are procuring intermediate services from outside India will be liable to pay GST under RCM. So the proposed amendment of intermediary services will come into force from the date the finance bill receives the presidential assent. So once the finance bill is incorporated into the Finance Act, this amendment will automatically come into picture. So accordingly, I would advise the taxpayers to closely monitor the date of the amendment, the date when the finance bill gets converted into the Finance Act, and proactively plan their transitional period, refund claims, and all the contractual agreements with the foreign service providers, so that they are not denied any export benefit. So the next important amendment relates to valuation under GST, specifically post-supply discounts. This amendment shall come into force on such date as the central government, by notification in the official Gazette appoint. So this amendment has been proposed under Section 15, subsection 3, subclause B. So till now, in the current scenario, Section 15, subsection 3, clause B of the CGST Act permitted deduction of post-supply discounts from the value of supply only when a set of conditions were cumulatively satisfied. So Section 15 deals with valuation, that what will be the value of taxable supply on which GST shall be levied. Section 15(3) allowed deduction of discount from the taxable value. Clause A dealt with pre-discount and before the supply has been effected, and subclause B dealt with the post-sale discounts. So in case of post-sale discounts, there were a set of conditions which were required to be cumulatively satisfied, which included that the discount was pre-agreed. That is, there was an agreement between the supplier and the recipient, and it was entered into before or at the time of supply. So post-sale discount could only be given if there was a pre-sale agreement between the supplier and the recipient. And second condition was that the post-sale discount is specifically linked to a relevant invoice. So there has to be a specific linkage between the post-sale discount and the relevant invoices that was issued for sale. The third condition for deduction of post-sale discount is that the ITC attributable to such discount has been duly reversed by the recipient. So, in practice, these three conditions created a significant hardship, particularly in case of volume discounts, ERN incentive, target-based discounts and financial credit notes, which are often determined post facto and are not invoice specific. So a lot of companies, have received notices who provided post-sale discounts, year-end incentives, that whether your recipient has received reversed the input tax credit or not, and whether you have a pre-sale agreement, or whether this post-sale discount is specifically linked to any relevant invoice. So as a result, deduction of many genuine business discounts were denied during the GST assessments and departmental audits, which led to GST demands along with interest and penalty, thereby resulting in an increase in litigation. So the government also took note of this ambiguity and has acknowledged the same by proposing an amendment to Section 15, subsection 3, Clause B. So the clause related to the post-sale discount has now been amended, and after the approval of the amendment, post-sale discount will be governed solely by the issuance of a credit note and the proportionate reversal of the ITC by the recipient. So once this amendment is approved, post-sale discounts will be allowed subject to fulfillment of two conditions. That is, a credit note has been issued under Section 34 by the supplier, and ITC has been reversed by the recipient. So the requirement of a prior contractual agreement for such full discount will no longer be necessary once the amendment is incorporated in the CGST Act. So, I feel that the onus will now lie on supplier to ensure that the recipient has duly reversed the corresponding ITC, which has been levied on the credit note. So I believe that the introduction of IMS mechanism, and verification of ITC reversal will be possible by electronical means, thereby ensuring greater transparency and significantly minimizing future disputes. So, using the IMS mechanism, I believe that the supplier will be able to track whether the recipient has reversed the ITC or not, in fact. So in this context, Section 34 has also been amended. Section 34 deals with the issuance of credit notes, and it has been simultaneously amended to include credit notes issued for post-sale supply discounts, which has been contemplated under 15(3)(b), in fact. So there has been a linkage between Section 34 and the post-sale discounts under Section 15, subsection 3, Clause B. So this amendment bridges the long, standing gap between the valuation provisions and the credit note mechanism. So now credit notes are clearly recognized as the only route for post-sale price adjustments, and the exclusion of discounts from taxable value will now flow seamlessly upon issuance of a compliant credit note under Section 34, along with the ITC reversal by the recipient. So as a result, I believe that going forward, departmental assessment would be towards genuineness of discount and compliance with ITC reversal, rather than asking for a for technical preconditions such as the existence of pre-supply agreements or specifically, linkage to the invoices. So overall, I believe that this amendment appears to substantially enhance the legal certainty and are expected to reduce avoidable litigation relating to post-supply discounts. So in my view, this amendment reflects a more mature GST framework, one that acknowledges commercial realities, promotes ease of doing business, and strengthens certainty in tax administration. So now I would discuss the amendment of Section 54, which deals with refunds, and this amendment in Section 54 shall also come into force on the date appointed by the central government by issuing a notification in the official gazette. So currently, as provided under subsection 6 of Section 54 of the CGST Act, a provisional refund of 90% is available only in cases of zero-rate supply of goods or services, or both, that is exports and supplies to SEZ. So if you are making export of goods and services or supplies to SEZ of goods or services, then in that case, once you file the refund application, a provisional 90% refund is instantly issued by the concerned officer, and the balance 10% is issued once the whole refund application is scrutinized. So now the finance bill proposes to expand the scope of subsection 6 of section 54, and it will now include the refund of unutilized ITC on account of inverted duty structure. So going forward, provisional refund of 90% shall be available not only for zero rated supplies, but also for refunds of unutilized ITC arising on account of inverted duty structure. So this amendment appears uh, to be solely with the objective of streamlining and expediting the refund mechanism in cases of inverted duty structure by enabling grant of 90% provisional refund, and it will definitely improve liquidity for such taxpayers who are into inverted duty structure model, and would definitely improve cash flows for such taxpayers. So the last amendment that I would be discussing is insertion of a new subsection in section 101A of the CGST Act, and this new subsection shall be applicable from 1st April 2024. So just to give you a brief background, section 101A was introduced in the CGST Act to address the problem of inconsistent and conflicting advance rulings, which were issued by different, advance advance ruling for authorities in different states. So, to ensure uniformity in the interpretation of GST law, the provision contemplated, Section 101A contemplated that the establishment of a national appellate authority for advance ruling as a centralized appellate forum. So, because of this issue, Section 101A covers that there should be a national appellate authority for advanced ruling who will pronounce the final outcome in case of divergent views on a particular issue. However, the National Appellate Authority for Advanced Ruling has not been formally constituted till date, and the appellate mechanism could not be effectively operationalized till date. So, this has resulted in a legal vacuum, leaving taxpayers without a functional forum to resolve conflicts which arise from divergent advance rulings. So, the GST Council in its 56th meeting recommended that until the National Authority for Advanced Ruling is constituted, the principal bench of the GST Appellate Tribunal should function as the National Appellate Authority for Advanced Ruling. So the present amendment, the new subsection seeks to provide statutory backing to this recommendation. So accordingly, clause 140 of the Finance Bill 2026 proposes to amend section 101A of the CGST Act by inserting a new subsection, which is subsection 1A. So this subsection largely empowers the government to authorize any existing authority or tribunal to hear appeals, the appellate appeals until the National Authority for Advanced Ruling is formally established. So this amendment, will introduce a interim appellate mechanism which will ensure continuity in the advanced rulings appellate framework, and it is definitely a significant step towards achieving uniformity, certainty, and predictability in the GST interpretational issues across the various states of India. So these were the proposed GST amendments, and should we now discuss customs or direct tax first?
We can do customs.
Okay, right. So I think Soumya will be taking the customs part, right?
Yes.
I just want to add something over here on the intermediary part, which Sarthak has just dwelled upon. On the intermediary, if we see the finance bill, it says that as Sarthak also said, that the section 13, subsection 8, clause B is omitted. So if we read Supreme Court judgments on repeal and omission, and if we also go back to Income Tax Act, similar thing happened under the Income Tax Act also a few years back on specific domestic transactions, wherein under transfer pricing SDT was there, and it was also omitted. So a lot of tribunal judgments are there which relied upon Supreme Court judgments, which said that once a provision is omitted, it is omitted from inception. So it would be considered as if it was never in existence. So we can consider that income tax judgments also. And there is one Supreme Court judgment in the case of Rayala Corporation 1970 AIR 494, which is the judgment on repeal and omission. They discuss repeal, they discuss omission. And on that basis, we can conclude that yes, the intermediary thing is gone since inception, since start of the law. Over to you, Soumya. Thank you so much.
So one point actually, since Pranshu has given his thoughtful views, when the service tax, there was a when the GST Act came into picture from service tax. So a lot of notices from the service tax regime was issued under the GST framework, and it was argued, repeal and savings clause was argued that there is no such clause in the GST Act, and therefore no fresh notices for service tax can be issued. But there have been number of divergent judgments on this issue. In fact, some courts have said yes, service tax notices cannot be issued under the GST regime, while there has been some divergent views on this issue as well. I'll check, in fact, whether is there any service high Supreme Court judgment on this issue. So definitely, it can be argued that yes, since there is no repeal and saving clause in the GST Act, then intermediary services, the past issues will automatically, will be finished, I would say. So let's see whether there is any clarity issued on this issue or not going forward. Yeah, Soumya, over to you.
Thank you, Sarthak, Pranshu. Pranshu, may I know what is the year of the Supreme Court order?
1970.
Okay, because I don't think this has been used at all, because intermediary issue has been seen a lot in the past 2 years, especially with NOS case, all of that, which is going on in Supreme Court. So I think either this case has not been discussed or not highlighted. So if you could share this case.
So Rayala Corporation is only on omission or repeal. They discuss repeal and omission.
Yeah, so we can use repeal and omission to say that intermediary is never part of it, like you said, from
Yes,
ab initio.
yes. I'll share that. It's
Yeah,
1970 AIR 494.
All right. Good afternoon, everyone. Thank you for joining us and giving us your valuable time. So I'll be discussing only the customs part of the budget. I would like to divide the customs part into three main aspects, which is structural reform, because there has been a lot of classification dispute in the past many years. Actually, the most customs problem that we see is classification. So there has been a lot of changes in the classification, addition of new classification, as well as omission of a lot of classification HSN line items. This has been done primarily to also make it parallel to GST law, because when goods are classified under GST law, the classification code is picked up from HSN, which is your harmonized system of classification of World Customs Order. Therefore, the budget has tried to streamline both GST as well as customs, so that there is no ambiguity when you are importing the same product versus when you're manufacturing the same product in India, as to the rate of basic duty on that product. Second part would be rate rationalization. Of course, we have seen that because of the mega notification which came in October 2025, or notification number 45, which amended, exempted, as well as rationalized over 120 products, customs products. Therefore, it was a speak towards the budget, and it somehow all of us knew that most of the changes that's going to happen in terms of taxation in this budget would be in customs. Anyway, there was always the changes in GST has been happening for the past 5 years, as well as in income tax for the past 2-3 years. So the thing that was left was custom, and October 2025, this mega notification gave us a very huge hint that only customs is now left to revamp. Now, the third structure is ease of doing business. It's a hassle when importers and exporters are trying to import or export any products inside and outside India. So therefore, these are non-tariff barriers, which means that even though there is not a rate that the duty that we have to pay, but because there are so many documentation, because there are so many tick marks that we need, so many approvals and permissions that we need, the timeline to deliver a product from country A to country B increases from say 15 days to 45 days. And this creates a non-tariff barrier, and it disturbs the global economy as well as the importer and exporter. Now, I would like to divide the changes in the budget in three primary pillars, which is first impact on big importers, exporters, or big companies. Second would be MSME, and third is the individual. Now, as Sarthak had also discussed, there has been changes in the validity of advance ruling. Now, in customs, the advance ruling earlier was valid for a period of 3 years, and which means that a importer or exporter had to renew their advance ruling after the second year, because even renewal process takes time. So therefore, if you increase it to 5 years, the importer and exporter now gets a breathing space, so they can increase their business and also continue their business in a more streamlined and smooth process. And now, if one advance ruling is applicable for 5 years, then it becomes even more easier, unless there is any other legislative changes, for the same advance ruling to become active again for 5 more years. 3 years is a very short time. 5 years is still a good enough time for the customs officer to know whether that line item, that heading is correct or not. Now, the impact of it is not just on the person getting the advance ruling, but also on others, because even though the validity of advance ruling is only on that person specific or that company specific, they can at least use it to show that, okay, this line item has been used under this BCD, and therefore this rate is applicable. And therefore, if they also import it under that very line item, then they are most likely saved. Second important change is the reduction of the pre-deposit, which was earlier 20%, and this has been reduced to 10%. Now, the impact of it is the 20% pre-deposit that we had to pay was 4 crores, 5 crores, and this is just 20% of the tax demanded. This is not even part of the penalty or the interest component, etc. This is only the tax demand. So now that has been reduced to 10%, which may amount to 2 crores, 2.5 crores. I am not very sure whether this 10% is a very good idea. It could have been reduced further. However, it's better than nothing at all. So, because this affects the cash flow of the company hugely. It impacts, it stops their cash flow, the payback of that pre-deposit happens only at the end of litigation, depending on whether you win or lose it. So therefore, it's a good change rather than no change towards increasing the cash flow in the business of the company. Now, the third big change that has happened is consolidation of all the proceedings. Earlier, what happened is that if a company was importing from 5 major ports, say from Gujarat, from Odisha, from Kerala, from Bengal, etc., and there are 5 proceedings going on against them, then they had to appear at 5 different places. Now, customs is trying to consolidate all of these proceedings in one specific jurisdiction or area, and try to litigate it in a consolidated manner, and also rationalize the penalty and interest of all of these, for example, 5 litigation in just one penalty or one interest. Earlier, you would have to pay 5 penalties and 5 interests. Now it will be consolidated as a one litigation. Secondly, even the litigation part, the interest part of it has also been capped. Earlier, the interest would go on till the end of litigation. The time period for the interest to be calculated on went on till the end of litigation, or till the time you paid some amount. Now that time period has also been done away with, and there will not be an additional interest component because of that time factor. The biggest change, as I had also discussed a bit earlier, is the rationalization of the customs tariff. The mega notification changed almost 120 plus line items and either exempted or reduced or in some or the other way decreased the basic customs duty on these items. This clearly shows an intention of India to compete in the global market with quality products as well as quality services, and not just fight a tariff barrier that we are seeing US doing right now. So this seems like Indian domestic market has become very, very robust for the government to open up India's frontiers and reduce the tariff barriers. However, a word of caution over here is that even though tariff has been reduced, this does not mean that the effective rate has been reduced. The effective rate on any product comes through the mega notification, read along with the legislation that the finance bill produces. By way of an example, I can give you is, suppose product A is at a rate of 30%, which has been reduced to say 20% in this budget notification, but the mega notification provides it to be at 7.5%. Therefore, the effective rate of duty would be 7.5%, even though the legislation gives us 25%. But this also means that in the future, the mega notification can be amended, and in future it can come up with a new notification which says, okay, now the rate of duty is not 7.5%, but some X%. The only play that the legislation over here has is that the rate can never be over 25% once that it has been amended. So we have to be very careful as to what sort of rationalization has been done as regards the effective rate of duty. Now, one simple change that has been done is to Section 67 of the Customs Act, wherein warehousing of goods was allowed, and shift of goods from one warehouse to the other warehouse was also allowed, provided you get permission and some regulation done by the regulator of the warehouse. So this has been done away with. Now, if you have to just transfer your goods from one warehouse to the another, you do not need a permission, specialized permission to move it, especially for non-dutiable products. You can transfer your goods as long as you are compliant with all the regulatory requirements and the regulator of the warehouse is aware of it. So this shows that India is trying to improve the ease of doing business tremendously, as well as help in smoothening the compliance burden of the importers and exporters in India. Now, coming to the MSME part, small and medium businesses, uh, uh, discussing only the important points. Firstly, the budget has expanded the definition of Customs Act to include the exclusive economic zone as well. Earlier, only the domestic area of India was included. Now, the exclusive economic zone, which is 200 nautical miles in the waters of around India, is also included, which means that anything which the fishermen or anything which is found in that area is also now India's jurisdiction. Especially fishes found in that area is now duty free for all the fishermen. One very good point that the customs law is trying to do is follow the income tax by making it into a unified integrated system, wherein all import export transactions, documentation, etc. will be visible for one individual on one unified platform, thereby making the transaction very smooth and very seamless and very less time consuming, as opposed to right now wherein we have to submit it manually, firstly to the customs officer, then to the CHA, then to the person in the port, etc. So it used to take anywhere around 25 to 30 days practically. So let us hope that if a digital platform comes within 2 years, this time gap will be reduced to quite a bit. Again, body camera has been mandated to be fitted on every customs officer, because it's the medium or small enterprises which would suffer the most when it comes to importing or exporting of businesses, of products. Therefore, to enable medium and small enterprises without any impediment is the thought process behind it. There has been an increased focus on renewable energies, wherein there is a lot of exemption in importing of rods, importing of fuels, etc., for the manufacturing of nuclear energy in India. Likewise, if you are importing capital goods for the manufacture of lithium-ion batteries, that is also exempted. Coming to the most important part for individuals, I think, which everyone was very excited about, is the changes in the baggage rules 2026. This has been done for individuals, and the last change which was done for change amendment which was done for baggage rules was 10 years back. So the change in this year, the baggage rule was extremely needed, and it should have been done much before than today. First is the passengers coming through the Green Channel, who visited outside India and coming through the Green Channel, can declare their products, their goods that they have purchased via electronic medium 3 days before they are supposed to travel. Therefore, again, streamlining and smoothening the process in the Green Channel. Second is import to re-export declaration has been made easy. This is nothing but if a foreign tourist comes and purchases goods and services over here, and then they are going back to their country, so that becomes an export for India. So that transaction has been made easier. The documentation process, etc., has been made easier. Contrary to that, export to re-export declaration has also been made easy, which means that Indian individuals, tourists traveling outside India, purchasing goods and services and getting it into India, do not need to pay taxes twice or thrice, and that compliance process has been made much more streamlined and easy. Items which have been imported for personal use has been duties on items which has been imported for personal use earlier, which was at 20%, has been reduced to 10%. So this is a very good and big relief for individuals. Value of the goods that you are importing earlier, which was 50,000, has been increased to 75,000. The most important change for individual, two most important changes for individual which has happened is, firstly, if you are importing gold and silver, women can import 40 grams of gold and silver, men can import up to 20 grams of gold and silver. So now we are measuring it in terms of weight and not in terms of the value. Secondly, life-saving drugs, as well as drugs which diseases which do not have any cure as of now. More than 20 drugs have been made exempted, and they can be imported free of any duty. So these two changes have been extremely good in terms of changes in the budget. I think all in all, the changes in the budget in terms of customs has been more to emphasize on import and export, and to make India the next import and export hub, like China had been about 10 years back, and rationalizing the baggage rules, etc., which means that the government wants Indians to travel outside and import goods, and it also wants tourists. It also wants medical tourism. It wants tourists to come visit India and therefore increase the domestic capacity as well as GST in India. So I think all in all, there has been huge changes in customs, but we'll have to also look out for any sort of notification which may come in the coming months of April and May, because there are some clauses which are in effect, which will come in effect from April, which will come in effect from May, and there are some sunset clauses as well. So still the whole picture is not 100% clear, although these actions are very, very in the positive direction. But I think we should always be little aware and cautious of when the sunset clause gets activated or when certain law gets applicable from. That's it from my side. Thank you so much.
Thank you so much, Soumya. Thank you for sharing your thoughts on customs amendments. I just have a follow-up question. You said
Sure.
that the custom duty on personal items for personal use has been reduced for 10%. So it
To
is,
10.
yeah,
Mm.
so it is only for the baggage rules, or overall, if I'm importing, say, from a foreign website, something for myself, then the custom.
Yeah, it's for the second point is also included in this. If the bag. Hmm.
And IGST would be applicable separately, I understand.
I think so that I'll have to check separately. I've just seen the baggage rules as of now. I don't know if it is to be read with IGST.
Okay. Thank you so much, Soumya. So that's a relief.
IGST will be charged separately.
Huh.
So that's a relief for us if someone is shopping from overseas website.
Yes. That's a great relief because we like to buy a lot of foreign goods.
Yeah. And
Yes.
there are a lot of websites who are also exporting goods in India. And a lot of
Yes.
time customs, when they come to India on the port, you receive message from customs that you have to pay duty.
Duty. Yes.
That's why there's a challenge
Mm.
always. Because some of the websites say it's always duty paid. But somehow the customs in India charge duty on that. So it's a welcome step that
Yes.
is reduced from 20% to 10%. Thank you so much. Now we come on to the direct tax amendments which are proposed in this Finance Bill 2026. I have with me Mr. Prakash Sinha and Anjali, who will be taking all of you through the nitty-gritties of the amendment. I'll just take you route through you the amendments. So when this budget was announced on Sunday, I was not having much expectation on the direct tax side. I'll be very honest, because last year the act was revamped, the new act was introduced. It was Finance Act 2020. The new Income Tax Act 2025 was there, and we were not expecting much amendments in this act because the act had to come from 1st of April 2026. The only thing apprehension which all professionals had, or some of the professionals, I'll say, not all, had, that it may be deferred because forms and rules were not released. Though Income Tax Department always said that we will release those rules and forms in time, much before the new act will kick in. So as expected, the act is still applicable from 1st of April 2026. The new rules and the forms have also been introduced lately. So that's the reality. Now the strange part was that there were a lot of amendments under the 1961 Act, which is already going, and also there are a lot of amendments
Pransu,
to the new Act.
there's some disturbance in your internet here. Whether it is from my side or it is from your side. Can you please check here?
If anyone else is facing the same disturbance.
I can hear you, sir. Probably, Mr. Shinha, the network is weak at your end.
Okay, let me
Yeah.
check here.
So there were amendments under the new act as well as the old act, and it would be a strange situation, and it is a very strange situation that before the new act kicks in, some of the sections have been omitted under the new act. So before coming into play, the sections were introduced and they are now even omitted. And interestingly, what was the reason for this new act? Why this new act was introduced and why this was coming? That they wanted to streamline. They said that the old act had a lot of sections had a lot of overlapping. They had a lot of sections like 234A, B, C, 12A, 12B, and we want to get rid of it. We want to have a streamlined structure of sections. So that's easy, it's rational. But again, they have introduced another section which is 354A on merger of trust. So why again we are going back to the old regime and old forum? If we had to do this again, if we had to introduce sections like ABC again, then what was the purpose of this new act? So somehow I feel that the department or the ministry, the legislative, want to rationalize the act, want to give benefit to the people at large, but they don't understand that amendments per se will not make much difference. Though they do make difference, but they also have to understand that the difference should be at the ground level. They have to understand that educating your tax officers, your taxmen, or training your taxmen to not think that all the taxpayers are fraud, are chore, is something which is necessary. Because if that ideology or if that mindset is not changed, then administrating tax, income tax act would always remain a task. Now, under the 1961 Act, we were not expecting it, but yes, three major amendments and retrospective amendments have been introduced, which Mr. Sinha and Anjali will take you through. I'll just briefly talk about it. It's about document identification number DIN, which is again one of the litigious point here, and matter is pending in Supreme Court. Then another is on limitation on shelf drilling and ROCA matters. None of the ITAT is listening because the matter is again pending before Honorable Supreme Court. And third is the JAO and FAO issue, whether the notice under Section 148 would be issued by JAO and FAO. This government, since inception, if you remember, in 14, when this government came, there was a retrospective amendment on Vodafone issue. And this government, when they came into power, they said that we will not bring any retrospective amendment henceforth. But again, year after year, we see whenever there is a issue wherein the revenue is at stake, large revenue is at stake, the retrospective amendments have been introduced. Now, when these retrospective amendments are introduced, this shakes the confidence of the investor. This shakes the confidence of the taxpayers. Just imagine a situation: a taxpayer who has litigated all this while, reached up to the level of Supreme Court, say on JAWF or on DIN issue, has spent lakhs on his legal cost. And now what the government does, the government brings in amendment and say this would be retrospectively applicable. And what would be the fate of that matter? It would be remanded back again to the A or maybe to CIT appeal, and then the whole adjudication process would go on again. Who is at fault or who has lost in this whole scenario? The taxpayer has lost. He has lost the confidence, he has lost the money, and eventually he might have to pay some tax with large interest overall. Because all this while, few years have been gone by till reaching Supreme Court. Then again, if we go through the adjudication process, then again few years would go by, and the interest cost would be piled up on him. So such kind of retrospective amendment should be avoided, and instead, if these issues could have been clarified at the outset when these litigations were arising or at the initial level, because it is not as if Jao is still okay new, but shell drilling Den is still few years gone by. The Den was issued in 2019 and we are now in 2026. This could have been addressed. Now they have brought in a new section 292BA saying that if den is there, if the document is referenced by den, then it's okay. But if you see the whole act, there is no clause of den under the whole act. Den is governed by a circular, and you have not taken that circular out from that regime. The circular is still there. At the same time, the circular is also still there. The section is also there. And the section only talks about the order. It doesn't speak about the notices. It doesn't speak about the satisfaction note. It doesn't speak about the approval notes. What about those? Again, there is no clarification. Then again, that litigation would go on, and they might bring in some retrospective amendment again in future. So in all this scenario, the government, yes, they are rationalizing it, they are making it simple, but they also have to understand that if revenue is at stake, they should not bring in retrospective amendments. It shakes the confidence of the investor. They should either clarify these things at the outset. Uh, in this background, I'll ask Mr. Sinha to guide us through all these amendments, and I'm sure he has a lot of insights on DIN and other amendments which were brought in. Over to you, Mr. Sinha.
Thank you, BRICS CCI, and thank you, Uh, Pransuji, sorry. It is really a privilege to address this August gathering here. I will start my deliberation on the 4 issues here, and how just if anyone who follows the court and anyone who follows the direct tax litigations here, I'm not indulging into the indirect tax matters. I'm just trying to focus on the direct tax matters here right now. First, start with the Tiger Global. That is the starting point of this one's here. In the Tiger Global, how the case came in favor of the revenue, whereas it was in favor of the High Court, the case turned around, totally turned around, and to say that yes, now the TRC is not the only document which a SSC should rely for the purpose of determining the residency of an SSC. So therefore, on the TRC, it has come to the law here, how to take the benefit of the treaty also, what is the usage of the treaty, whether the treaty can diminish the right of the country here, or can take away the right of the country through some agreement here, to right to tax that any transaction through some agreement here, what is the status of the treaty, whether the treaty is a contract or whether the treaty will supersede the uh, constitutional value, or what will happen to the GAR versus treaty or SAR versus treaty or JAR versus treaty here. So all these things that we have seen in the case of the Tiger Global, and in the case of Tiger Global, court has said that any transaction which has been done with a purpose to avoid any tax matters here through the jugglery of agreements here, that cannot save the taxes in India. Through the what is protected through the treaty is the transaction, but not the arrangement here. If any arrangement which has some ulterior motive to take away the right of any sovereign country to tax this one, that is not acceptable here. The same trend continue here when we talk about the self-drilling matter, which Pransuji has raised just now. The self-drilling matter, and I had the privilege of arguing this matter before the court. What was the matter was there, whether the limitation timeline which is fixed under the 144C, the assessment proceeding which is fixed under 144C, has to be subsumed under the limitation of overall limitation of the 153 or not here. So in the last judgment which was given by the Supreme Court, Justice Nagaratna was in favor of the SSC, Justice Sharma was not in favor of the SSC, and this matter was pending before the larger bench here. Now the court has said, now that through this amendment, what the legislature is trying to say, that irrespective of that part here, 144C limitation will be different here, and it is not be counted within the limit of the 153. So now this case goes from the SSC here. Second part was that about the FAO and JAO matter, which has been raised by Pransuji also. FAO and JAO, all the high courts was in east. This matter started from the Hexaware case from the Bombay High Court here. And after that Hexaware, every court has followed this one, except the Delhi High Court and the Calcutta High Court. The Delhi High Court and Calcutta High Court has said that the JAO has also the authority to issue the notice under 148. It is not necessarily the FAO has to be issued. JAO means Judicial Assessing Officer. FAO means Faceless Assessment Officer. The matter was pending before the Supreme Court here. And now this court has said that, now the amendment has said that the JAO can issue the notice under 148 here, 148 and 148A. So therefore, this matter also goes again also goes, and now it has been, you can say, well settled in favor of revenue. Another matter which was there, it was issue of the document identification number, DIN number. In fact, in 2019, when Finance Minister was presenting the budget, she has very well said that if the document does not contain any DIN here, you can throw this document into a dustbin. That will not be a valid document here. However, after the 5 years of litigations here, SSC relied on that part here. Now the department itself is saying that having DIN number is not a mandatory one. Not having a DIN number is a curable defect. This defect can be cured also. So this means in last 3 cases here, the government has changed the goalpost here. They have changed the goalpost here after so much litigations here. Now they are saying that these are the things that they are doing. Yes, like 144C matters here. This is the amendment since 2009 here. So you can say that it was a very well retrospective amendment here. Coming to the discussion of all the 3 cases here, now we can see that how the government is looking into the budget here. This budget mainly focus on the areas where the government has tried to clarify their stand, where the government has tried to consolidate their stand, and the government has tried to say that some relief to the taxpayer here. Let's see what are the first part which the government is trying to say that I am doing some relief here. First part that is there, they have clarified that New Income Tax Act 2025 will be applicable from 1st of April 2026. So for the 2026 and 27, it will be tax year. And on that tax year, the assessment will take place from 1st April 27 onwards here. So the government has said that yes, it is a new act that will be coming into the force from the 1st April 2026 here. As per the new act here, since the new act has been recently passed here, the rules are also coming into, and the forms are also being notified right now here, which are into the process here. If you see that what are some of the major announcement on the issue of the taxation here. One such issue is that about the claim or the compensation under the motor accident claim tribunal here. The government has said that right now the government has said that whatever the compensation that you will be receiving, actually the compensation was never an income. It was never an income. The issue was only on the interest part here. So is whether the interest will be taxable or not. Now the government has come with an amendment here saying that whatever the interest that you are receiving on the compensation as per the judgment pronounced by the MACT tribunal here, that will be not subject to tax, and also that not will subject to the TDS part. This is the first part is there here. Second part which is there, since we have discussed about the TDS part here, second part is that government has tried to streamline the TCS and TDS part here. On the issue of TDS, the government has said that under section 206CC, that whatever the TCS is there, that will be uniform here, and it will be rate of 2% here. Similarly, in the case of wherever there is a remittance under the LRS scheme, and some tax has to be deducted here. In most of the cases, right now it will be 2% here. So that will be a big benefit for those individual whose son or whose daughter are living abroad for the education purpose, and they can remit it their money without any much deduction here. So it will be a very good advantage for that part here. One more advantage that is coming here right now, the government is trying to say that, right, if you want to avail the lower tax deduction certificate, you can file it is through the online system here. No need to go to the AO, and you can avail this benefit of the lower tax deduction certificate or no tax deduction certificate through online filing of the form. And once you have online filed the form, the AO will scrutinize this form and that will reply through the mail itself here, through the portal itself here. So no need to go to the department and no need of filing this form through the manual system. So it is a very big relief where some person wants the lower rate of certificate here. Another date 8 of this was here. One more important part is that whenever a person buys any house property, a person has to deduct the TDS under 194I A, I think 194I A, and he has to pay the taxes here. The issue are there, if individual who is deducting the tax, whether he should be paying the tax as per their PAN number or TAN number, or are you required to take a TAN number? TAN number means this was tax deduction account number here. The government has already clarified that when a person is purchasing any house property from a resident, then in that case, whatever the tax liability is there, that can be deposited by using the PAN number of the payer. However, this facility was not available in the case where the payment has to be made to a non-resident and the tax has to be deposited by the resident here. Now the government has said, what the government has come with the clarification here, or you can say amendment here, saying that if a person has to buy a flat or immobile property from a non-resident here, he can deduct the taxes here and he can deduct the taxes and he can pay the taxes using the PAN number itself. So no need of having a separate TAN number here. So it saves the individual from any more administrative compulsions or compliance part here. One more amendment that is there for the individual. I will discuss the individual part and after that I will come to the international tax part. One more benefit that is for the individual is the submission of the only 115G 15H form to the depository. Earlier, a person who is supposed to receive some dividend from, suppose that you have some shareholding, you have to receive some dividend from someone here, then you have to furnish the 15G 15H to everyone so that they should not deducting the tax on that part here. Now what you have to do, you have to submit the 15G 15H to the depository itself, and depository will pass on to the person who is deducting, who is paying you the dividend. And once they are paying the dividend, they will not deduct the tax here. So submission to the depository will be tantamount to submission to the company here. Now, this is the part here. Second part is about the return here. We all know that a person has to file a return if your income is above the taxable limit here. There is a 3 amendment which has come right now. First amendment is that for the purpose of filing of the tax return, a new date has been made here for those SSE who are not auditable and not filing the ITR 1 and ITR 2. This means those persons who are filing the ITR 1 and ITR 2, the due date for their filing will be 31st July. However, those person whose accounts are not auditable and also not filing the ITR 1 and 2, their date of submission of the ITR will be 31st of August. So this is the staggering of the ITR date of filing of the ITR. Second part in the ITR cases is that in many cases here, since the last date of filing of the ITR for anyone is 30th November, like those person who are into the transfer pricing, they have to file the return along with the 3CB by 30th November. And after that, to file the revised return, if there is some omission that is taking place, there was only 1 month time here. That was the only 31st December. Government has realized this part here, and now the government has extended the date of filing of the revised return, that is up to 31st of March of any of the assessment year. That is a very good development that is there. Another good development is that about the updated return. Many cases where the people face the 148 notice here, they have to file the return under 148. Now the government has said, if you have received a notice under 148, you can very well update your return by filing the additional tax, by paying the additional tax, and this updated return will be covered or will be tantamount as a return in consequence of the notice under 148. So these are the few amendment which is benefit for that part here. One more which is very much amendment which is very much necessary here. In the case of the individual who are returning from abroad here, in many cases they have not submitted their detail of the foreign assets into the FA schedule of the ITR here. The non-disclosure of the foreign assets and foreign income into the FA schedule has resulted a lot of notices being sent to those persons here, because it is the issue of the black money. Under the Black Money Act, if any assets or the income has not been disclosed, that will be treated as the black money, and that will be subject to the higher rate of income. This means 30% tax income and 60% penalty. Now the government has given a window. The window is there saying that if you are a person who has a small transaction, like suppose that you went abroad, you have some job there, you have opened a bank account, like some person who has got a shareholding ESOP from the foreign holding company or foreign company here. Some person has traveled abroad, some account there. Some students who were in abroad, they have their bank account, they have some asset. Like in India also, you can purchase the share of Apple or like this one share. In those cases here, if you are resident, you have the timeline that a 6-month window has been given to you to submit the detail of this undisclosed income, which is say that undisclosed income, and pay the taxes accordingly. Those persons who has not disclosed it, who has the legitimate income but who have not disclosed it here, they can also disclose it by saying that by paying the penalty of rupees 1 lakh rupees. I think that part here. However, if this benefit is not available to a corporate, to any other person who has not disclosed it or whose assets are higher value here. So that is the one of the disparity that is there. And I feel that once this law come into force on the ground of the equality, it can be challenged before the court here or like part here. One more important development is that now, as of now, what happens here? Assessment takes place in a different order and the penalty takes place in a different manner here, because the cause of action for the assessment is where you have some income which has not been disclosed in the ITR. So the department will say that yes, this income should be accessible to tax, and after this the notice is for 143(2) is issued and the assessment takes place under 143(3), whether it is a faceless manner or any other manner here. So there is an assessment order. Based on the assessment order, if there is a if your case is falling into any of the provision where you can say that yes, there is a misreporting or there is a underreporting here, then your penalty will be initiated under section 270A and blah blah blah. Now, as of now, the practice is that there will be two separate order here. What the two separate? Assessment order will be separate, penalty order will be separate, and these two separately takes you to different assessment appeal mechanism, where you file the appeal against the assessment order, you file the appeal against the penalty order. Now the government has said that both the order will be the same. Only one unified order will be passed. However, in the same order here, there will be addition. If there is addition, there will be addition under for the income tax purpose, and the assessing officer will be forming their opinion on the issue of the charging of the penalty, and the penalty will be charged here. So there will be only one order that will be passed now after 2027. So it is a very good development here, particularly that will give a bigger, that will avoid the multiplicity of the litigations here. Another very much important part is there. Since we have discussed about the penalty, we know that there is a mechanism called the immunity from the penalty, which is under section 270AA of the Act. As per the earlier law, which was the erstwhile law, you can avail the immunity only for the purpose of underreporting of the income, and misreporting of the income, which was subject to 200% of the penalty, was not subject to the immunity here. Now the government has said that you can avail the immunity for underreporting as well as the misreporting here, subject to the certain condition that you have paid the taxes, you have not appealed against the assessment order, you have paid the penalty also, or 100% under the misreporting, you have to pay the 100% of tax as a 100% of tax in lieu of the penalty, so that you can be given some immunity part here. So these are the few measures which an individual also can be getting the benefit also that part here. Another which is very much important part is that let's see about the first of issue is that about the foreign company here, or the foreign taxation here, or you can say that about the transfer pricing matter, where there is a big changes here. In the case of transfer pricing, there are five changes which is very critical here. Earlier, the IT system or IT services were classified into the four different services, and the safe harbor rule or safe harbor rate of the taxation was quite different for each of that part here. Now the government has clubbed all the four type of services into one and unified of services, and the rate, the safe harbor rate that will applicable is 15.5% only. So it is a very big development in the TP matter, and very big development in the case of the IT systems also, because it will give a rate of very lower rate. I will say that it's a very lower rate of 15.5%. The corollary of this is that now the safe harbor can be used not only for the 300 crore, not only up to 300 crore transaction, but up to 2000 crore transaction turnover also. So this is a very big development that is taking place here. Another part is that wherever government has entered, or SSA wants to enter the, you can say that APA part is there, whether it is a unilateral APA.
You know why I love it now. Only
Government has said that yes, they will expedite the unilateral APA also. These are the few development which is talks about, or the I have just discussed about the some part here. One more important part is that yes, about the MAT here. Under the new law, MAT is not there. So whatever the MAT credit is there, that has been to be accumulated as on 31st March 2026. And this accumulated credit, you can avail maximum 1/4 of that credit can be availed here. One more important point is there about the foreign company there. Those foreign company who are paying the tax under the presumptive taxation, like under the 44BB, 44B, BBBB, 44C, 44D, 44A, 44BB. These are the sections here. Now the government has said that if you have paid the taxes under the presumptive based taxation, you are out from the MAT. No need to pay the MAT here. So the foreign company is out from that part here. One more amendment which I would like to discuss about the very big issue. In many cases, we have seen that an employer, while depositing the PF or provident fund amount and the ESI amount here, he has to deposit. There are two portions of the PF and ESI. One is the employee contribution, one is the employer contribution. So the law was that the employer contribution can be paid up to the last date of filing of the return, that is under 139 here. But the issue was there, what will happen to the employee part here, whether the employee return will be covered or not here. There was a lot of litigations on this point here, saying that some court has said that yes, employee contribution can also be deposited up to the last date of filing of the return, and therefore they have allowed. In some cases, the court has said no, employee contribution has to be paid as per the due date up to the date of the payment under that respective statute, not under the Income Tax Act. So therefore has not allowed. The matter went to the Supreme Court, And in the case of checkmate, Supreme Court has said that the PF and ESI contribution of the employee must be deposited within the due date under the respective statute itself, not as per the income tax year. So therefore, when the payment has to be made within the date specified in the respective statute, then there was no case of delay here. And wherever there is a delay, that amounts used to be get disallowed here. Government has realized this difficulty, and government has said, now they have said that this amount, even the employee contribution, can also be deposited up to the date of filing of the return here. So this is a very good development, and I feel that we can take the advantage saying that these are the clarificatory amendment, and these clarificatory amendments should apply from the back date also. And wherever there is a disallowances for not depositing the tax within the due date, not depositing the PF within the due date of respective state, that benefit can be taken here. So into that part here. Now coming to the some another issue which I would like to discuss here. We have discussed about the software part. We have discussed about the this one's here 15.5% rate of taxation on the safe harbor. We have discussed about the turnover that will be applicable for 2,000 crores here. One more important part is that once you apply for the safe harbor under the IT rule here, unless the fact changes here, that 15.5% that will be applied, and this will apply as a rollover for the next 5 years. So it gives a lot of certainty to the taxpayer. One more important point which I like to highlight here, particularly for the individual and HUF, many individuals says that they have not got the benefit from this budget. One of the important element of the benefit is that, as we know that there are a lot of infrastructure development is taking place right now. And due to this infrastructure development, government is making the compulsory acquisition of lot of lands here. The issue arose earlier where the government is acquiring the land, whether this acquisition of the land in the hands of the individual or the HUF will be exempt from taxation or not taxation. So we know that if the land is an agricultural land, so there will be no capital gain. Since compulsory acquisition is a part of the capital gain, and the agricultural land is not a capital asset, so therefore it cannot be subject to tax. The government has come recently, the government has come with this budget here saying that whether it is a agricultural land or it is a non-agricultural land, both will be exempted if that has been acquired by the government for the purpose of under the compulsory acquisition scheme through the specified act, and you have got that is the Right to Fair Compensation Act here. So it is a very good law saying that whenever a person has lost their land, they can very well claim the tax benefit on account of this one here. Now coming to the other issues about the this ones here, we know that government is trying to develop about the critical infrastructures and the data centers. And this data center will be getting the benefit of tax exemptions for next 20 years here. This means up to the 31st of March 2047. This is the biggest, I feel that biggest mover of the budget, saying that now the foreign company can have a data centers, and these data centers, and through this data center, they can provide the services across the world. However, if they have to provide some services in India, they have to open an Indian arm, and through this Indian arm, the Indian arm will be providing the services to the local recipient. And for this purpose, this foreign company and their Indian arm, the safe harbor rule will apply 15% on the cost plus here. Another important part is that government has said, one major important government has said, which has to come through a rule here. Those returning Indians or those foreign experts who are coming to India for the purpose of working into the data center or anywhere else, they will be exempted up to a 5 years period from the global taxation here. This part is very much important. The rule has to be come out for this part here. They will be getting exemption from the global taxation. So please mind this one. Suppose that one person from Japan comes to India, they have we and he sits in India in the data centers. As we know, as per the Indian rule, if he has lived in India for more than 182 days, he will be a resident in India. And once he becomes a resident in India, his global income becomes taxable in India. Now the law is saying that even if you are resident in India, but your global income will not be taxable in India. So this is the carve out from the section 5 and section 9 of the act here. Very much important part is that here. One important part is that about the electronic component manufacturing here. And on this electronic component manufacturing, the non-resident will be subject to only 2% of the income will be considered, where you are doing this electronic manufacturing in the bonded warehouse. Your markup can be only 2%. And on this 2%, if you are paying the 35% as a rate here, so only 0.70% you have to pay the taxes. And that is a big relief for that purpose here. We have discussed about the TCS rate. We have discussed about that part here. MAT rate we have discussed. One more important part about the buyback of the share. We know that buyback of the share was always said that yes, the promoters are doing for the purpose of tax planning. Now, the government few years back said that I will consider this buyback as a dividend, and therefore it will subject to the dividend under section 222E(f) of the section here. And based on that dividend, you have to pay the tax onto this part here. Going back into his own earlier part here, government is now saying that buyback will be subject to the capital gain tax. Now buyback is no more dividend here. So therefore, you cannot claim any deduction on account of interest on such dividend. Another part that the government has said, now there's an amendment which is coming here saying that now there will be no deduction of interest in such earning of the dividend. So earlier section 56 was there. We say that dividend is taxable under the head income from the other sources here. In the other sources here, you could have very well claimed the deduction under the interest here. But now the government has said, no, you can't claim any deduction of interest. So that deduction of interest also goes from the hands of the dividend recipient here. So these are the few changes that I have tried to suggest here. If there are any questions here that we will take up here. Now I will, Anjali ma'am. Anjali ma'am will be taking, yes.
Because I had one question here regarding
please.
the buyback.
Hmm.
The buyback now it is suggested to be taxable as a capital gain instead of deemed dividend in the budget.
Yes.
Now, whether it will be calculated as a long-term capital gain, short-term there is capital gain. We have to categorize this like this as the
Yes.
calculation is there.
Yes, that will be there here. Only part is there. The promoter will be also subject to tax, because in this case here, apart from the shareholder, the promoter will also be subject to tax. And if the promoter is a domestic company, the rate is something different. If the promoter is not a different domestic company, the rate is something different here.
Okay. Thank you.
If any questions on any tax part here that I can take up, no problem.
Sure, so I think we will be taking the Q&A session at the end of the meeting today. Till then, Miss Anjali, I would request you to please begin with your part. Thank you.
Yeah. Almost all the major amendments of the budget are already taken up by Prakash, sir. Few things I like to bring to your, few things I like to bring more. Regarding the definition of the manpower supply, especially regarding the TDS, there is always a confusion whether the TDS is applicable under 194J or 194C. There is always an ambiguity. In this budget, this ambiguity is removed, and it is very clearly specified that the manpower supply will come under the definition of the work. That's why it comes under 194C, and respectively there will be a TDS of 1 or 2% individual, non-individual under 194C. One more thing I like to precise over there, as Prakash sir already told us that regarding there is one more date regarding the tax filing, 31st August for non-audit business and trust. There is one more thing I like to add up here. There should be a compulsory maintenance of books are required for the SECs who are non-audited business or trust. For them, there is a date of 31st August. One more date is introduced for filing the income tax return. And one more amendment is regarding the STT on the futures and the options. In the futures and the options, the STT rate in regarding the future is hiked from 0.02% to 0.05. And regarding the options on premium and the exercise, both raised to 0.15%. Regarding MAT, there is a reduction of the MAT tax from 15% to 14%. Few more amendments in the MAT in which there is a clarification regarding the MAT for in case where there is an applicability of MAT for domestic companies, non-concessional regime. That means that we are not opting for the taxation for 115 BAA and 115 BEB. Previously, the MAT is applicable, MAT credit allowed for future set-off. But in the budget, MAT to be the final tax liability. There will be the no MAT credit, which is allowed to be carried forward. In the existing provision, the MAT is carried forward for 15 years. The difference of the excess tax which we have paid in the year in which the over and above the normal tax rate in that year, the MAT credit is allowed. But now the MAT will be the final tax liability and no MAT credit is allowed. Further, in case where the domestic companies opting concessional regime, the MAT is not applicable in the existing provision. Now, in new provision from 1st April 26, there is a transitional period in which 25% as a transition relief is allowed of the accumulated MAT credit and 75% will become a sunk cost. So no further credit is allowed and 75% now will be the sunk cost. However, 25% benefit will be allowed. Regarding the foreign companies which have opted for the presumptive taxation in the new budget, which is effective from 1st April 26, foreign companies opting for presumptive taxation regime fully exempted from MAT. This means that the foreign companies under presumptive provisions, Section 44BB, oil and gas services, Section 44B, shipping businesses, aircraft operations, and turnkey power projects. So they are fully, it is clarified here now that they are fully exempted from MAT. So these are the few more add-ups which I want to give as Prakash sir already covered. And one more little thing, SGBs. In SGBs, there is also a very big amendment in which the subscriber who's an individual and subscribed at the original issue and held continuously till redemption at maturity. They also can avail the exemption from the taxation regarding this. This is the all which I want to discuss in addition what the Prakash sir has given us.
Thanks, ma'am. Thanks. You have rightly covered, which I missed out here. So you have
Okay, sir.
rightly supplemented me. Huh?
No,
Thanks,
sir,
thanks,
you
ma'am.
never missed out. So one,
Yes,
if
please.
anything anyone wants to say, otherwise I'm having one query with Prakash sir.
Yeah, please ask me.
So it's my particularly a specific case I like to discuss.
Yeah.
An SSE has transferred some of the, they have not transferred actually the amount, they have bought a property in Dubai.
They
So
have abandoned their property.
they buy
Yeah,
one property
yes.
in Dubai.
Yes.
And they have not filed any FDI,
Yeah.
nor they declared that asset in India.
Yes.
And the property, they start getting the rental income also.
Yes.
And they open a bank account in Dubai.
Okay.
So what we have to do today, because in the budget regarding that foreign asset, there is a huge taxation and the penalties also now. So what do you suggest what the SSC should do?
Very good question. I will reply in bit detail here. Please bear with me 5 minutes here. First question that we have to ask here, from where he has got the money for the purpose of purchasing of the house property in Dubai here. Whether this money was transferred through the LRS scheme from India, or this money was a self-generated money from abroad here. The first source of the money here. If suppose that if the money has been transferred under the LRS here, and after this he has purchased a house property, then yes, he has purchased. So there is a legitimate source of the money. This money was a tax-paid money which has traveled from India to outside India for the purchase of the house property here. Second thing is that if it is a income which is generated from outside India, used outside India, then can you say that yes, this was the business income from outside India and it has been used there here. These are the two issues that will come. The third issue will be there. First, determine during the year when he has purchased the property, whether he was a resident or non-resident here. If he was a resident here, then the situation will arise here that whether he was living in India and after this he was purchasing the property in India, outside India. These are the few fact situations that have to find out. Now, second situation that came in, it is not only the property, but it is the rental from the property that is there. So there is a one asset and there is a one income from that asset that is also coming from here. We know that if there is a rental income that is arising from a asset which is located outside India, that cannot be taxed in India, that has to be taxed in the source country where the immovable property is located here. So once the immovable property is located in Dubai, it will be taxed only in Dubai. So you can take the immunity, only that immunity is there here. So all this situation is there here, just trying to find out whether there was merely a non-disclosure or it was a non-disclosure of the income as well as the non-disclosure of the asset also. If there is a genuine money, if there is a legitimate money which has flown from India to outside India, declare it right now in the FS schedule here, saying that yes, you have the property, you have the bank account there, whatever you have this ones here, and try to get use of the window which is being opened for the purpose of 6 months here. So, and also declare the foreign income here, or the rental income that is there. Because if you are a resident here, although that income is, you can very well take the benefit of the treaty that this income solely has to be taxed in Dubai. That income has not to be taxed in India. These are the few things that will be there. So very good point here, which is there, and try to get the right now the suggestion is that right now the window is there for 6 months. Avail the window, disclose all the assets there here. Then the taxability part can be discussed separately here or can be argued separately.
Thank you, sir.
All right, then we have got to Shaw, please continue.
Yeah, Sarthak, are you there?
Yes, I'm there.
Sarthak, regarding that credit note, the discount credit note,
Yeah.
that means we have to raise a full invoice first and a
Yes.
credit note for the discount,
Correct. Absolutely.
right? And as per the GST Act, the credit note should be accepted by the party. If they are not accepting it, then what to do?
See, first of all, आप acceptance का मतलब कह रहे हैं कि IMS में वो reject कर रहे हैं, right? This is what you mean to say.
Yeah.
So in that case, फिर तो आप पार्टी से डायरेक्टली बात करिए इनफैक्ट कि why they are not accepting the credit note. मतलब आप किस बेसिस पे पहली बात तो क्रेडिट नोट इशू कर रहे हैं कि आपकी कमर्शियल अंडरस्टैंडिंग के खिलाफ है वो, फर्स्टली वो रिजेक्ट तो तभी करेगा ना जब आप जबरदस्ती ही क्रेडिट नोट दे रहे हो इनफैक्ट. So it should be pre-agreed between the supplier and the recipient, I would say.
It's pre-agreed.
Otherwise, rejection होने का reason क्या है?
We are not able to find out the reason though the mail are saying, but we are not getting any reason. And the party is not accepting that credit note though they are pre-agreed.
No, it's a benefit for them, ना? I mean, it's very. I mean, why are they not accepting? वो तो उनको benefit ही मिल रहा है देखा जाए तो in fact they are getting the prices lower. जितने में उन्होंने purchases करा था in fact उतने से कम में उनको वैल्यू मिल रही है, then what is the reason of not accepting? In fact, I mean, this is what one must know first.
Okay, let me try
वैसे
that.
टेक्निकली अगर आपका क्रेडिट नोट रिजेक्ट हो गया है तो वापस आप उसको आईएमएस रिटर्न्स के थ्रू नहीं फाइल कर सकते. The only remedy available is to amend the credit note. In fact, आप B2B क्रेडिट नोट से जाके अमेंड कर दो उसको, तो वो वापस रिफ्लेक्ट करेगा ऑन 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 देयर पोर्टल. इनफैक्ट, क्योंकि एक अगर आप सेम नंबर का क्रेडिट नोट ऑलरेडी फाइल कर चुके हो अपने GSTR1 में, वापस आप उसी नंबर का क्रेडिट नोट नहीं फाइल कर पाओगे ऑन योर पोर्टल. सो द ओनली रिजॉर्ट इज टू amend the credit note with the same value, same invoice date, and same credit note number.
Okay, thank you.
Right. Thank you.
All right, and before we call it a day, I have received two queries from the participants of the session. So I would request anybody among the speakers today to kindly address the query. Mr. Kabir has asked, what are the biggest growth drivers for emerging from the budget 2026? So he basically wants to know the growth drivers that has come out of the budget.
I will reply this part here.
Sure.
Look, this budget has to be seen in a long-term perspective here. This budget is the one of the step towards the developed India, which the government is trying to make here. When we try to say that develop India, they have tried to say that here. They have tried to ease of living here. They have tried to cut hole these ones here, block the loopholes where there was a lot of litigations were there. They have tried to empower that taxpayer, and they have tried to make the law a bit simpliciter also. One of the major threshold that I want to see, that major driver, is that the growth in the IT part here and the growth is the data centers here, which is the biggest benefit that they will be receiving here. If you can see, any foreign company can open a data center in India, and this data center will be exempted from tax for the next 20 years up to 31st March 2047. How much the employment that will be generated here, and this data center will be a big boost like a GCC in India. Like GCC, Global Service Center or Global Capability Center, we usually say here. Global Capability Center is right now, is the backbone. Is earlier it was an IT, but IT has getting replaced with the GCC part here. It is not only the IT part here. IT is getting much more wider definition. Wider definition here, and GCC is getting much boost into this part here. The way that technology is getting changes here, like AI is coming, ML is coming, that is the many thing development is coming here. It is a time where this IT systems, IT software, R&D, that should be a biggest part that the government has emphasized into that part here. And right now, it is rightly given the boost here. In fact, the thrust has been kept onto this part for the purpose of development here. The second part, which is there right now, is the development of the chips here. Right now, the development of very much sophisticated chips here, and for the purpose of the chips here, the government wants that there should be a corridor for the purpose of the rare earth mineral, which the China has a dominance right now here. The government is trying to make a pocket here. So these are the pocket where you can say like Odisha. Odisha is the big source of the mineral part here. So they have Odisha, Jharkhand, they have tried to say that, yes, these are the part where they will be setting up the rare earth mineral mines here, and from where they will be extracting here. Till now, in fact, even though we were knowing that rare earth minerals are the very much required for the purpose of the new technology that is coming, particularly it is being used in the chips here, there was no firm policy for the purpose of that part here. So you can say the policy has come right now for the development of the minerals here. Third part that I have discussed about the AI chips here, lot of chips that is going to develop here, because these are the development that has to take place if India has to excel itself here in the sector here. Fourth sector, which is very much, you can say, the infrastructure sector. The infrastructure boost that the government is giving right now, whether it is by way of the bullet trains that we call it is a high-speed railway tracks. Right now, the 7 projects they have announced here, roads which is there here, many more things that is coming for the purpose of the Northeast development here. So these are the development push that the government is trying to that part here. So I feel that when I say that how to see a budget here, generally people see the budget from their tax perspective here, saying that how much whether मेरा tax का slab बढ़ा कि नहीं बढ़ा. They are always concerned कि 12 lakh से 13 lakh हुआ कि नहीं हुआ. That is a different way to see here. But if you see the overall part, like I just said that you have got right now, you have got the exemption from the capital gain tax on the acquisition of the non-agriculture property when it is done by the for the purpose under the Fair to Right Compensation Act here. This was not there earlier. So any property will be transferred under that act here that will give an exemption under the capital gain tax here. Like many more cases here, like on the issue of TCS, on the issue of TDS here, whoever is remitting the money outside India, their cash flow is getting reached here. So all this development, if you see the proper, there may be not a direct tax benefit here, but lot of benefits are there in the picks and pockets here. That can be used for the purpose of the individual, that can be used for the purpose of the corporate here. Like right now just has been mentioned that those foreign companies who are paying the presumptive taxation here are not required to pay the MAT here. The MAT is closed. MAT is the final tax here. So whatever you have the benefit, you can claim the benefit in the next subsequent year. So many more changes is there. Only thing is that how you look into these changes here.
Adding on to what Prakash sir said, I think the growth drivers, I think India is ready to collide head on with developed nations like US and China to become one of the superpowers in the next 5 to 10 years. To do that, we cannot anymore rely on just Delhi, Bombay, Chennai, the big metro cities, or adjacent metro cities to develop the economy. So now they are focusing on tier 2, tier 3 cities more. So there, if you look at their rare earth mineral belt, it's focusing on Odisha, Kerala. Of course, they have the reserves, but then their coconut policy, then their she mart or something, women policies, etc. It's focusing more on the development of the other cities now. So it seems like the growth opportunity for youngsters is now no longer just limited to the metro cities. You can start your small business from your house and scale it, grow it, and also take it worldwide.
I guess that very well defines your query, Mr. Kabir. So the next question is, how will tax reforms influence business sentiment and consumption demands? The participant wants to basically know how the reforms in the tax would have effect on the businesses in the future.
Look, may I reply this part here?
हाँ जी, आप करिए please, प्रकाश जी.
Yeah. Tax is one of the important component of the economy here. And I'm not going into the much of the theory part here. You must have seen the recent amendment in the GST, where the GST rate was reduced and that part here. This GST has given a lot of boost into the economy during the Navratra days and the Diwali days here, where the economy has developed like anything. Consumption has boosted up here, and there was a high demand of the cars and high demand of the any vehicles here, through which the government has also earned lot of taxes here. Even though the tax was rate, the consumption was so much high here. So tax rate is very much important component to decide the consumption. The higher the tax, the lower the consumption. The lower the tax, higher the consumption here. So if the government will try to, for the most important part to boost the consumption is that the tax should be lower. Once the tax is lower, the taxpayer has the enough money in their hand. When the taxpayer has the money in their hand, they will definitely consume it or invest it or somewhere else. Where their consumption is there, their consumption can be daily life consumption, purchasing of the car, investment can be there, or the long-term planning can be there. So first of all, in a good economy, it is very much important that tax should be lower so that your taxpayer has the enough money in your hand and they can decide from that part here. So one basic principle what your question was that tax and consumption, the lower of the tax, the higher of the consumption. It is the basic economics theory that we have read in the Karl Marx theory here. The second part is that the moment tax rises, consumption will go up, go down here because the people don't have the money in their hand to consume it here. Third part, yes, we can go on arguing that part here, many more part here. So, but you have to really see about the time also. It is already 4:55 here. Yes, we can go on discussing about it is the economics here. It is not about the anything that to do this budget here. It is totally economics here. What we have read. Yes.
Anji, see, two things I want to highlight over here is firstly, as Prakashji said, that lower the tax, more the consumption. So, when the GST rates was reduced in September 2025, and thereafter, the tax collections were equal into the previous months. So, for October, the GST collection was almost identical to the tax collections of, August, September. So, this clearly highlighted that the consumptions have increased, because same tax collection tha, so obviously at a lower rate आप same collections कर रहे हो, so that means आपका consumption बढ़ा है in that case. I mean, the sales must have increased at that point of time. तभी tax collection was equal into the previous months. So yes, consumptions have increased, and apart from that, coming back to the question, tax reforms for businesses का एक future perspective क्या है? So I believe that as far as GST is concerned, as I said earlier, there has been a good benefit for the exporters. एक जो intermediary services हैं, उसमें effectively you are getting a benefit of 36%. You will not be paying 18% GST output, and additionally you will be getting a refund of ITC of 18% in fact. So that is a major boost to all these industries, all the BPOs, KPOs, and all the marketing service providers who are providing services to foreign clients. So it's a very good boost to them in the coming years.
I think one basic reform also that comes parallelly from what Prakash ji and Sarthak said is that more and more businesses would want to be compliant, and more businesses would want to take up GST registrations and pay their taxes. So जो black economy है वो कम होगा, and if the black economy goes down, then obviously tax collections would increase automatically. It is said that India's black economy is almost parallel to the GDP it actually has. So imagine how much black economy is going on. So if we transfer that black economy slowly into this, then imagine the kind of development India will actually have. And it will percolate to each one of us. It won't just affect the businesses.
Right.
Very good, ma'am.
That is a wonderful fact shared, Ms. Soumya.
Thank you.
All right, then, unless we do not have any more questions, I think we are good to go. I once again thank everyone who have joined us today in this, in-depth discussion on Budget 2026. We have uncovered key insights, debated economic policies, and gained valuable perspectives from, of course, the industry experts. The budget lays the foundation, but its success will definitely depend upon the effective execution and the collaboration of businesses. Let us continue this dialogue beyond today and be the responsible citizens of the country that we are. Of course, as mentioned, being responsible means not to create more of the black economy or to reduce our part in creating one. Once again, on behalf of BRICS CCI, we extend our gratitude to all our esteemed speakers today, our audience, and our distinguished guests for making this event a success. We look forward to seeing you at future engagements as well. Before we wind up today, I would request everyone to kindly switch on their cameras for a quick group picture. Thank you. Thank you so much, everyone. Thank you once again. We look forward to having you in our future discussions. Bye-bye.
Thank you.
Thank you.